Hello everyone, welcome to today's video, how to read a mortgage statement. Well, as you can see here, this is an actual screenshot of a monthly mortgage statement. Depending on who you have your mortgage with, you should see something very similar to what you're seeing on the screen. Now, before we dive into how to read a mortgage statement, I think it's important to understand why we need to do that. The main reason being, for most people, their mortgage or their house is the biggest expense they have. It's the biggest purchase most people make. So it's very, very important to know where your money is going and how it's impacting your mortgage, how it's reducing every month and every year. And not understanding that and not planning accordingly could have big consequences for one's finances. Before we dive into this mortgage statement, I think we first need to understand what makes up a mortgage statement. The mortgage payment is consisting of four parts: the principal, the interest, the taxes, and the insurance. The principal is the amount that directly goes to paying down your mortgage balance. For instance, if you have a $100,000 mortgage and this month your principal was $200, now your mortgage payment is now $200 less than $100,000. Interest is what your bank collects for lending you that money. This is the so-called profit they make for lending you the money. And as a borrower, you pay that cost. Then comes taxes and insurance. Taxes, for the most part, are your property taxes. And insurance, for the most part, is your homeowner's insurance that protects your home in case of an earthquake, a fire, a flood, or any other natural calamity. It depends on the coverage you take on the insurance, but that's basically it in a nutshell. So, coming back to the mortgage statement. This is an actual screenshot of a mortgage statement, and you'll see that the total monthly payment is $1,206.70. Out of that $1,206.70, $284.93 is going directly to the principal, which means now after this payment has been made, now the owner of the home owes $284.93 less than they did last month. The interest here is $351.18. That money is what the bank keeps. Your mortgage is not going down by this amount. This is unfortunately a money that you will never see. This money is gone. Then comes escrow. But before we move into that, I want to point out something. The principal and the interest, if we add these two, 284.93 plus 351.18, $636.11. That amount, the addition of the principal and the interest, the total of that amount will not change for the entire life of the loan. Whether you have a 5-year loan or a 15-year loan or a 30-year loan. This amount, when you add the principal and the interest, the total amount will remain same month over month. Now, as you make your timely payments every month, the principal amount will go up by a little bit every month, which means to keep the $636.11, that number same, the interest amount has to go down every month, which is exactly what happens. So every month, as you keep making your timely payments, your principal amount will slowly increase, your interest amount will slowly decrease. So as you keep making these payments, more and more of your money would be going towards the principal, which is what you want, and less of your money would be going towards the interest, which is also what you want. So your principal and your interest, the addition of that should always yield the same number. Now, we talked about principal, we talked about interest. But what happens to tax and insurance? We don't see that here. We only see escrow. So what is escrow? Think of escrow as a checking account that you don't have access to. The bank creates this escrow account, and the money you put in there every month, in this case it's $570, it goes into that account and it's stored there. Because as we can see from the picture, your taxes and insurance, those are the two things that would be paid from your escrow account over here. So why not just take the money and call them taxes and insurance? Well, because unlike your principal and interest, your tax and your insurance is due once a year. And when it's due once a year, it's usually a considerable amount. And a lot of people may not have the money set aside. So the bank creates an escrow account where they take money from you every month and put it there and just keep it there for you. So when the tax bill comes for your property or the insurance bill comes for your property, they pay it from that escrow account. Now that you understand what happens in your mortgage statement, how to read it, I would like to say a few extra things. When you take out your mortgage, in most cases, your mortgage payment will go up by a little bit every year. Why is that? Because your principal and your interest, like we said, the total amount would always remain the same if you add them up. So why would it go up every year? It would go up because of your tax and your insurance. In most cases, every year, the county or the government, they increase the taxes on your property because in most cases, the value of your property goes up every year by a little bit, but it still does go up. Same with insurance, because labor costs go up, the cost of material goes up, inflation, et cetera, whatever the reason is, usually insurance cost goes up as well. Due to the increase in taxes and the increase in insurance, the amount required on your escrow amount will increase. And that is what increases your mortgage payment. Usually it's not a significant increase, but it is an increase, and I recommend planning for it, and hence having a mortgage payment, if possible, that is lower than what you can afford. So when it does go up, you're not in trouble. So that is pretty much it. So to summarize, the total payment for this mortgage was $1,206.70. The principal is the amount that goes directly in paying down your debt or your mortgage. The interest is the amount that the bank keeps for lending you the money. Escrow account is a separate account, kind of like a checking account, where the bank stores your money so that they could pay the tax and the insurance on your property. And fees is any late fees or any other form of fees that the institution may charge you. If you automate your payments, you can avoid any late fees. So that is pretty much how you read a mortgage statement. Hope you found this video useful. If you have any questions, please leave them in the comments below. Hope you guys have a great day. See you in the next one. Bye-bye.